Once again, good morning, all of you. A warm welcome from Team CGPI. Before we start, we would kindly invite your attention on the following instructions to be followed during the meeting. We will mute everyone at the start of the meeting except for the speakers so that the session is not disturbed. Please make sure you have muted your microphones and video throughout the session. If you wish to ask any queries, there is a chat window available. We'll enable the chat window at least 20 minutes before the session. You will get a message. Please do not ask queries when the session is in progress. A sincere request for this smooth running of the program. Well, topic for today is the permanent establishments and fixed establishments, interplay of income tax, GST, and a digital world. This is a very niche topic. We all of us, and it is drawing source from income tax, GST, and the digital world. So it will be a very intriguing session. And who better can do justice to this topic? None other, our very own Advocate K. Vaitheeswaran, sir. Good morning, sir. We welcome you all. Good morning, sir. We welcome you. Now, the part of introducing sir. Mr. Vaitheeswaran obtained a law degree from Madras Law College and enrolled as an advocate in 1990. He has obtained graduated cost and works accountants qualification from the Institute of Cost and Works Accountants of India and has completed the Associate Company Secretaries qualification from the Institute of Company Secretaries of India. He joined the office of Mr. Subaraya Iyer Padmanabhan and Ramamani in the year 1990 and became a partner in 1998. He started his own firm in 2000 and currently operates with offices at Chennai, Bengaluru, and New Delhi. He has about 30 years of experience in advisory capacity as well as through appearances before the appellate authorities, tribunals, courts in matters arising under domestic and international tax laws, excise and customs, service tax, VAT, CST, GST, FEMA, FERA, company law, and even the insolvency and the bankruptcy code. He is considered as a specialist in tax and legal matters with in-depth knowledge of the business and tax laws as well. He has addressed hundreds of seminars and conferences on law and taxation across the country and abroad, and is a most sought-after legal professional in GST and business restructuring matters. He's an expert in real estate contracts and has recently forayed into technology law and artificial intelligence. He advises clients across the country on various verticals such as manufacturing sector, retail, healthcare, food and hospitality, gems and jewelry, media and entertainment, information technology, education, charitable institutions, societies and clubs, logistics, infrastructure, real estate, shipping and aviation, travel and leisure, banking, and financial services. He also advises various associations and chambers of commerce. He wrote the first comprehensive book, VAT in India, when VAT was introduced in 2005, and has also authored books on SENVAT credit, books for students appearing in the CA final exams. He has written hundreds of articles covering variety of issues in tax, corporate law, constitutional law, and general laws in both print and the digital media. But friends, his most, the best work that he has done is his new book, Taxation of Digital Economy, covering international tax and indirect tax aspects, which has just been released both in the print and the e-version both. This is one of the best works we have seen till now. So I recommend everybody for this particular book. He's the chairman of the expert committee on GST, Madras Chamber of Commerce and Industry, and also a member of the General Committee of Madras Chamber. He is a member of Finance and Taxation Committee of Confederation of Indian Industries, Southern Region, and Vice President of the Revenue Bar Association. He is also a member of SIC, the Indo-American Chamber of Commerce. He is a recipient of the Vocational Excellence Award from the Rotary Club of Madras Southwest. He is actively involved in various social causes through music and also forays into humor writing. I very well recollect the way he mixes humor with the laws. And sir, we are looking forward for it even today. Speaker, sir, it's a privilege for us to learn from your experience. Over to you, sir. Please start the session.
Thank you so much, and good morning to all. It's a wonderful vehicle that we have in the name of webinar, and all of us find it so convenient to just hook onto our laptop or iPad or phone and listen to the speaker and participate in the discussions. I've had my share of speaking in the last 2 months, and I've had my share of listening also in the past 2 months, and both journeys have been great. And I think all would agree that the biggest advantage of a webinar is that the spouse and the children also agree that you should not be disturbed for at least 2 hours. So some element of your escaping from chores also happen at home to some extent. So all this, keeping all that aside, it is seriously brilliant learning and phenomenal academic exposure to everybody. The younger generation is very lucky, extremely lucky. If they've taken advantage of this, it's probably the best they've taken for their career. It's even more interesting for people who have spent 10 or 2 or 1 or 2 or 3 decades in practice, because it's time to relook at everything, relearn every other aspect. So I think despite what COVID is causing in terms of its havoc, in terms of business and things like that, it has really opened up learning vistas. And with that, when the CGPI talked to me about an interesting topic, with this idea, I also grabbed the opportunity because it's a nice thing to link both the legislations of direct tax and indirect tax. There are professionals who either practice only indirect tax, some of them practice only direct tax. Over a period of time, I've enjoyed the practice of both, and I thought I will share whatever I have in terms of knowledge learned over a period of time to put across to you so that it can be of some use. Next, Ranjan. So this is a story which you have heard. We are now nearly coming July will be full-fledged 3 years into GST. Nobody can deny it's a tax reform. It's definitely a phenomenal tax reform. Not take away that reform aspect of it. Some news items yesterday indicated that our April GST collections were 70% of the usual collection. That is an indication. And expect GST to grow when business is closed and business is not moving. And there were issues even before COVID. Only complicated. It's going to be difficult for GST revenues to turn around. So, but you cannot deny the fact that it's definitely a better system than what it was before, because we have harmonized taxes. We've eliminated the cascading effect of tax to a large extent. We'll have our section 17s and things like that, but we eliminated the cascading effect of tax. There will be phenomenal supply chain management benefits that happen. One nation, one market is definitely there in the sense that the rate of tax is common across the country. Today, I don't have a problem of if I locate myself in Maharashtra, if this is the rate. If I locate myself in Rajasthan, this is the rate. If I locate myself in Karnataka, this is the rate. That is no longer there. I can locate myself anywhere depending upon which state is offering me incentives, which state is offering me investment potentials, which state is environmentally friendly and things like that. I may just go back. So I can take a decision to locate myself anywhere and still supply to a customer in any part of the country and still gain the business. VAT regime had that complication. Because if I have a customer in Maharashtra and I had to supply from Tamil Nadu, I would lose the market. So I had to forcefully establish a business in Maharashtra to make a local store. Today I can choose the state in which I can operate and still make an interstate supply, still charge GST and still retain the customer. That's a brilliant development as far as GST is concerned. And we have widened the tax base, though we have not gained from the widening of tax base, so that takes a lot more time. But in that process, in this journey, we have created the most complex legal landscape. GST was supposed to be a simple solution. And in fact, there used to be jokes going around saying that professionals would be irrelevant as far as once GST is implemented, be just a smooth law. And lawyers and accountants would not be required. It will be just a smooth compiling that you can do an SMS and finish it off. Well, all of us know what is the reality. And to understand even a notification, you need a professional advice. The kind of landscape that we have. It's a complex act, rules and notifications, and look at the number of notifications, 109 CGST rate related notifications. Matching SGST, sometimes you don't have a matching SGST notification, so what happens? Rules have been amended multiple times and many times retrospectively. Most of the rules are under challenge in courts. There have been circular after circular, and circulars have also had this story of getting withdrawn ipso facto from inception. So it is definitely a complicated landscape. And for import of goods, we are having an IGST through Customs Act. So customs also comes into the picture. And it is a fact that everybody is grappling with technology. And the legislation has been amended multiple times. And the amendments are also not come into force because it's a huge challenge. You have to amend the CGST Act. You can't just like that notify that amendment unless it has got relevance only for CGST. Amendment has got a relevance for SGST. Then you have to wait for all the states to amend their SGST Acts. That is why you would have seen that the CGST Amendment Act 2018, most of the sections got notified only from 1 to 2019. That clearly indicates that it takes a long journey for an amendment to take place as far as Act is concerned. Next. Straight away, I'll go to the subject. Cross-border transactions have both the direct tax and indirect tax impact. First, let's look at the transactions per se which are involved. Somebody could import goods into India. Somebody could export goods from India. Typically, services, somebody could be an importer of services, somebody could be an exporter of services. Then there could be branches located outside India. There could be inter-office transactions. There could be company-company, intercompany transactions, both from a holding subsidiary perspective or a group perspective. Next. So let's look at item by item. If you look at import of goods, when the goods touch the customs frontiers of India, when the bill of entry is filed, when customs legislation is triggered, you have the payment of customs duty. And even though IGST is a levy under the IGST Act, in terms of the proviso to Section 5, the levy of IGST on import of goods is inextricably connected to the import of goods. Therefore, if there is an import of goods under levy of customs duty under Section 12, then the IGST will tag along, and the IGST is levied through the customs tariff. It's another day to debate whether those provisions are legal or not for today. Then you have import of services. In fact, Section 7 itself is very interestingly worded. If you look at the first element of 7.1, Category 1, it talks about supply in the course of furtherance of business. When it comes to import of services, there must be consideration, but it need not be in the course of furtherance of business. Therefore, import of service could be by a taxable person. Import of service could be in the course of furtherance of business. Import of service could be by a consumer. Import of service could be from a related person or from another established outside India. It's quite wide in terms of. Then we have export of goods and export of services. Next. So from a service perspective, most critical in the entire space of IGST is the place of supply. In fact, the place of supply would be the biggest litigation in the next 10 years. It will rock the course. Place of supply portion 12 as well as Section 13 of the IGST Act. Now, some of the key terms are also will be the subject matter of debate. So let's look at one of the key terms, location of a supplier of services. It looks like a simple provision, but it is a matter of debate. Where a supply is made from a place of business for which registration has been obtained, location of such place of business. Where supply is made from a place other than the place of business for which registration has been obtained, a fixed establishment elsewhere. Now, this becomes a factual matrix. How do you demonstrate that the supply has been made from a place which is not the place of business for which registration has been obtained? So for that, you need to break your head as to what is the fixed establishment. And if it is a fixed establishment, is there a supply emanating from that location for it to justify a categorization as a location of supplier of services? In fact, I don't want to go deep into technical examples, but let me take a simple example of a professional. You could be a lawyer or you could be a chartered accountant. Let's take example of a chartered accountant because more relevant. The sense that a chartered accountant could be based in Mumbai, could be having a GST registration, paying GST for their professional services of audit and consulting and advisory. Now, the chartered accountant has got a property in Ahmedabad, and this property has been let out for commercial. So, when the chartered accountant lets out a property located in Ahmedabad for commercial purposes, what is the location of supplier of service insofar as the chartered accountant is concerned? Of course, we know that the place of supply for accommodation, renting, etc., would be the location of the immovable property. So the place of supply could be identified. Yes, it is Ahmedabad. But what is the location of the supplier? Does the location of supplier also shift from Mumbai to Ahmedabad? So that will be the key question. So the key question would be is whether the CA has got any fixed establishment in Gujarat for providing this kind of services. Is there a location? Can you say that tenant's property is your location? The answer would be no. Tenant's property is tenant's property. You have no access. You have no, you can't even enter that property except for in the terms of the tenancy agreement for verification of something. You don't operate from that location. You don't provide renting from that location. You are providing as a passive owner or a passive owner of the property from Maharashtra. Therefore, this is a simple example, but there could be much more complex examples when it comes to business. In case you are going to supply from more than one establishment, whether the place of business or the fixed establishment, location of the establishment most directly consider the provision of supply. Again, I'll give you a chartered accountant example. You are an auditor based in Mumbai, and you're doing audit for a client who's based in Hyderabad, and the client has got multiple locations throughout the country. And these locations also involve factories, inventory. Of course, during COVID, it is very difficult to physical verification. But assuming you have traveled and you have branches which have participated in this exercise, then which is your fixed establishment, or have you provided supply from multiple establishments? If you have provided supply from multiple establishments, are you specific locations for each of the services, or is it the place of signing which is the key location for the supply location, and the rest of them are only satellite units providing services to the headquarters? Kind of issues can happen even to a professional. So imagine the impact in business. Then if none of them are applicable in absence of places, the usual place of residence of the supplier, and in the case of company, to be the corporate office. Next, corporation office. Next, please. This is a mirror definition of location of recipient. You can skip this. So one of the key terms used in both definitions, both location of recipient of service as well as location of supplier of service, is the word called fixed establishment. This is not an Indian definition. It's been borrowed from Europe, partly from UK VAT as well as EU. So fixed establishment means a place other than the registered place of business, which is characterized by sufficient degree of permanence and suitable structure in terms of human and technical resources to supply services or to receive and use services for its own needs. If you look at it, there are two critical segments. It must have a sufficient degree of permanence. Now, how do you determine what's a sufficient degree? Would you call an ATM located at a bank as a fixed establishment? Let us say somebody is supplying soft drinks to a machine, and the machine is located at the theater. Can you say that it has got a sufficient degree of permanence? Or can you say that an oil rig that is located in waters, can you call it as having sufficient degree of permanence? Does it become an establishment? These are some of the questions which we'll examine during the course of the discussion. And the second element is required is that it has got some suitable structure in terms of both human and technical resources to supply services, receive and use services for its own needs. Now, classically, I will dissect this in the post-COVID scenario. The post-COVID scenario, every government is saying, please implement work from home, don't allow employees to come to your office. And bigger companies started, the IT were always used to work from home, but all other sectors have also started. Chartered accountants, of course, there is no concept of working from. They were home and office were all merged into one. 24 hours they're working, therefore there was no concept of working from. Lawyers at least had this element of going to a court and then coming back, and therefore they could say home is different from home. They maintained that distinction. When I'm in office, I'm in office, and I'm in my home, I'm in my home. In fact, initial days I used to have this. Some of you can follow this. It can have this visual act of actually removing my office visually from my own body when I enter the house. Like just a visual act to indicate that this is house, this sanctity is completely different. You will not bring office. Once you get into office, you don't bring house unless it's an emergency. So typically, if this is possible in some professions, but in some professions, it's like doctors, it's impossible. For CAs, it's even more impossible. The fact that you will have to work at 12 o'clock in the night to get that return. But the point is, today, if work from home happens, and many companies are asking their employees to work from home, and major work happens at home, major work like order happens at home, discussions happens, contracts are executed from home. Can you say that the residence of the employee has become a fixed establishment for the professional? Can you say that there is a sufficient degree of permanence? Now, that is where the challenge will be. It will not have a sufficient degree of permanence. Can you say that one employee would constitute human and technical resources? Now, that would be a challenge. If you're going to put 12 employees in one location and say that this location has to deliver something, that may probably have some kind of a suitable structure. Clearly, an employee residing at home and working from his house cannot by itself create a fixed establishment. In fact, this question came up in the context of income tax as to whether this would constitute a permanent establishment, because some employees are forced to work at home. whether that execution of orders from home can trigger a permanent establishment. Or there could be a situation where a person is forced to reside at home and do certain acts for the company that can create a PE. The OECD has given a guideline recently in March 2020 to say that it would not create a PE, but then it has its own precedent. I mean, in terms of persuasive value, we don't know what the tax will ultimately hold. So we are going to have a live debate on work from home as we go forward, both from a GST and PE perspective. Then the second definition which is critical is place of business. This is very widely defined. We have discussed this in many number of seminars as to what is business. So I'll just skip it for the moment. Ranjan?
Yes, sir.
Next. So I'll straight away go into issues. See, what I'm going to do with this entire set of presentation is that I'm going to take up cases both from GST, from indirect tax and direct tax, which have touched upon this subject, and then juggle it around and play it around in terms of both PE and FE and see where we are. See, fundamentally, there is no definition of permanent establishment in the Income Tax Act. Permanent establishment is a creature of a treaty. The treaties between two countries would decide and define what would constitute a permanent establishment. Sometimes they constitute a permanent establishment based on the number of days at a particular site construction work. Sometimes they would constitute a permanent establishment as an office which is open. So there's always they'll say branch office. They won't use the word license. So that each treaty would have its own definition of permanent establishment. What you would see in the Income Tax Act is not a definition of permanent establishment, but a term called as business connection. So if one section 9, a business connection can be established, then the income of the non-resident can be in India to the extent of profits attributable to Indian income tax. With that background, just a simple background, let me straight away take through case laws, then bring the story again. All of you are familiar with the Formula One race. It's a very, very powerful event and very well acclaimed event, and a lot of fans for the Formula One race. So the Formula One championship came to India. So when it came to India, obviously was a race of that kind requires a racing track, requires infrastructure, requires some kind of facilities, requires environment where you don't have people invading that space. You need some kind of access controls and things like that. Therefore, a Booth International Circuit was identified, and the foreign company was given access to that place. And that particular place was at the disposal of the foreign company throughout that tournament period, to be about a week or 10 days to 12 days. Now, with this facts, the matter went to AAR in income tax, and from AAR, it went to finally it landed to the Supreme Court. And the Supreme Court gave this judgment by saying that the Booth International Circuit is a fixed place where the commercial or economic activity of conducting a championship was carried out, and one could clearly discern that it was a virtual projection of the foreign enterprise, namely Formula One, on the soil of this country. Therefore, the fixed place, that is the international circuit, was fully at the disposal when it conducted the business, and the taxable event has taken place in India, and a non-resident company is liable to pay tax in India, income that it has earned on this soil. Now, how did this whole story happen? The whole story happened because there was a doubt whether income accrues or rise in India, and there could be a tax impact. And why did that question come? That question came because this, as far as India is concerned, we have this question all the time, whether it is taxable in India. We don't care. The tax authorities sometimes won't even care that, other countries may not be taxing it. I'm quite surprised that Formula One does not happen only in India. Formula One happened across the world, but most other countries did not choose to examine whether an excess is created or a establishment is created. But there was a fear that that question might come, and therefore matter went to AR, and revenue contested this matter heavily, and the matter went to Supreme Court. And when you have powerful counsels arguing the matter and jurisprudence on both sides coming into play, then landmark judgments will come. So what is happening? What is the effect of such a powerful landmark judgment? Formula One will never come to India. No other race will ever come to India. No other tournament will come to India of that magnitude, because they would see that it creates unnecessary tax issues. So we need somewhere balance our growth of our country as well as our obsession to assume everything is taxable and everything has to be tested in a court of law and everything has to be taken to it. Next. So the question that I'm posing would be, if on account of a decision, on account of an interpretation of law, on account of a new principle that is evolving, a PE is created under the Income Tax Act. If a PE is created under the Income Tax Act, will it be considered as an FE for the purpose of use? Because if you look at FE, going back to the definition, sufficient degree of permanence, suitable structure in terms of human technical resources to supply the services and to receive and use the services. So what happened in Formula One case? There was an Indian company. This Indian company called JP had entered into a race promotion agreement with the foreign company, whereby the foreign company said JP would get the right to host and promote this event in India. The total consideration payable by the Indian company was USD 40 million. And there was a separate artwork license agreement whereby the foreign company permitted the Indian company to use certain IPR for a consideration of USD 1 million. Purely from a JP's perspective, what would JP think? JP would think that, look, I'm an importer of services. I've gotten an agreement with the foreign company. The foreign company has conferred me certain rights. I've paid him 40 million for that purposes. A foreign company has conferred me certain IPR for which there is a consideration. Therefore, this is an import of service, and the foreign company does not have a location in India. So the Indian JP comes to a conclusion that the location of supplier of services is outside India. Location of recipient of services in India, section 13 is applicable. Therefore, the place of supply is triggered in India because of the various clauses in subsections in 13. And therefore, he comes to a conclusion that is import of service. And now you have a judgment which says that the foreign company has a P in India. So if foreign company has a P in India, would it change the situation that the foreign company now has a location as a supplier of service in India? If that is the case, then can JP say different, can take a different course?
Excuse me, sir.
Yes.
If I can, so very sorry to interrupt. Sir, can you come a little closer to the microphone because voice is a little weak and cracking also.
Fine.
So okay.
This is better?
Yes, sir. Better. Thank you so much, sir.
Welcome. If the transaction is a supply of service between the foreign company and JP, it becomes an import of service. So the question for JP is whether JP should pay IGST on import of service under RCM, or can JP take a stand? Look, you have a P in India, and you have a P which will definitely amount to an FE. Therefore, you should charge applicable GST after obtaining registration of the circuit. And if you have not charged, and the transaction is now moved from a reverse charge to a forward charge, and therefore I'm not liable unless I'm made liable under law. You are liable to register and charge me the GST. So there could be questions like this. Importer pays IGST, and then the P receives a notice for GST. Second question. P is even liable to GST. Assuming you concede that P becomes FE and therefore they should take registration because they're carrying on business in India and therefore they should charge GST on this transaction. There'll be issues in valuation because there is no consideration that is payable to that particular location. The consideration is still payable to the foreign location. And then from a foreign country's perspective, this transaction will reflect as an export of service or export of goods as the case may be, depending on what the transaction is. So typically, it opens up a Pandora's box. Depending upon one decision, which can turn the tables for the status of the foreign company, and a P is created for the purpose of income tax purposes, and profits attributable to taxation as far as Indian soil is concerned is identified and taxed. Same logic can extend to GST. There is no answer to this question as on date. We'll only see how it goes forward. But the ways we can answer this question is to say that my contract as far as JP is concerned is not with the permanent establishment, but only with the foreign company. And therefore, the recipient of service as per my law, as per my definition, is the person who pays me the consideration. The person who pays me the consideration is a foreign company, and therefore I will treat it as an import of service, not otherwise. And we still have to see, we're very early days in terms of interpretation of all those sections as well as those provisions. Therefore, this is definitely one thing which you can flag for probably future developments in terms of this. Let's look at another example from a location perspective. There's a Japan-based company. It is engaged in the business of manufacture of consumer products, and it opens a simple liaison office in India. And all of us know how a liaison office operates. The activities are very, very preparatory in nature. The liaison office is not authorized to discuss terms of the contract or initiate contract. It was only open to act as a communication channel. But the liaison office would have facilities. It will have a rented facility. It will have people working. There is no restriction on number of people so long as they work only on this purpose. The cost of running the liaison office is paid by the Japanese company. So questions can arise as to whether a liaison office is an intermediary or whether a liaison office receives the money in foreign exchange. Therefore, it is zero rated supply. It is export of services. So let's look at it from an income tax perspective first and then come to GST. So Delhi High Court on identical facts held that the liaison office did not undertake any trade or commercial activity by itself. The contract negotiations were done by the head office personnel. Liaison office was not a permanent establishment. Next. FEMA guidelines FEMA regulations are very specific as to what is a license office. It's a business to act as a channel of communication between the principal place or the head office, by whatever name called, and it is in India, but which does not undertake any commercial activity, trading activity, industrial activity, directly or indirectly, and maintains itself out of the inward remittances received from abroad to normal banking channels. Now, it is not a PE in India, but it has got a rented facility, it has got a premises, it has got an employee. So does it have human and technical resources, suitable structure by way of human and technical resources? Does it have a physical presence in the sense there is a permanent suitable, there is a location, physical location, it has office infrastructure. So can it be considered as a fixed establishment? If it is considered as fixed establishment, what happens? Next. Normally, I don't refer to AR rulings as a policy because most of the AR rulings are against the SSC. And the AR rulings are has got its own challenges because unlike the income tax AR, the AR which is manned by a three-member bench, of which one is headed by a retired Supreme Court judge. In case of an AR, as far as GST is concerned, it is manned by two sitting officers from the tax department. So it is as good as an assessment order. Either way, in fact, maybe fair of the C, but against the C, it does not create a binding precedent. Surprisingly, people still go for ARs and activity when an AR is pronounced. There is a lot of literature and discussions about AR. Thereby, unnecessary importance is given, and people are likely to get exposed to being settled otherwise in terms of normal interpretation. So there is one favorable AR which I'm just putting this because it touches that issue, therefore I'm covering it. So AR Rajasthan said that supply of service liable to GST only if separate consideration is charged. When funds are received for payment of salary and reimbursement of expenses, it does not constitute consideration. The license office does not have independent revenue or clients. It's only representing the headquarters. Therefore, they said it is not a supply and therefore it is not taxable. Now, assuming a license office becomes ME, now there are, just like how you have developments in GST, the international tax is also going through a major set of developments. And therefore, after the settled the position as to what would constitute a PE, what is the supremacy of a double taxation avoidance agreement, what is the advantage of a treaty shopping, how I can locate myself wherever I want, how I can structure wherever I want, all countries got together and said that this has got to stop. And therefore, after a lot of debates, we are now seeing a massive change in the DTAs through what is called as MLI. So through this lateral instrument, quadrilateral instrument, a massive change would happen. And therefore, there is a possibility that the Delhi High Court decision may not be valid later when that for such of those countries which are such of those DTAs which are affected by those MLI amendments. And if LO becomes P, would it require registration? And then again, the question could be, what happens if the LO becomes a P and recovers cost plus margin? Would it be a supply? If it is a supply, then can I not say that it is an export of service? Company is incorporated in UAE. It provides geophysical services to ONGC. The AR in the context of income tax held that the applicant has a P in India in the form of vessels. And they said the vessel itself is a fixed place P for the purpose of the contract, and the vessel performs all the activities in India. And this was the reason for them to hold that it is a PE for the simple premise that the vessel is also at the disposal of the applicant. Now, if the vessel is considered as a PE, can it become an FE for the purpose of GST? We now have to test whether our FE definition is met. Does the vessel meet the test of sufficient degree of permanence? Does it have suitable structure in terms of human and technical resources to supply services and receive use and services? Next. Now, there is a provision in the IGST Act which says that where the location of supply or place of supply is in the territorial waters, the location of such supply or place of supply shall be deemed to be the coastal state or the union territory where the nearest point of the appropriate baseline is located. So now, if the vessel is identified as a P and the vessel has got its own infrastructure, the rig has got its own infrastructure, rig has got a lot of people working on it, the rig receives services, it receives catering services, it receives personnel, it receives engineering support, it receives marine technical support. There is a lot of activity happening in the particular vessel or rig, as the case may be. It may have legs, but it still moves and moves itself at a particular location. And if that is treated as a P, can it also be treated as an FE? There is a possibility. And if it is treated as a place of business, then the question would be, where is your GST applicability? Then you have to look at section 9 and then determine the nearest coastal state. And then you have to identify what could be the GST exercised by it. Next. Now, just as I talked about vessels, what happens in the case of ATMs? There are companies which supply ATMs as part of their service. They locate the ATMs at a particular bank location. They manage the ATM. They take care of the infrastructure of the ATM. They provide the cash support to the ATM, the security at the ATM. That by itself can become a place of business. If that becomes a place of business, that may require registration. Then we look at the fourth scenario in the context of location, which is another famous ruling of MasterCard, AR ruling from income tax perspective. This is a landmark ruling because it upsets so many known concepts. Matters, of course, are still pending at a higher level. We'll know the final outcome at a later date. But you need to understand what really happened. So typically, the applicant was a global payment solution provider, and he was facilitating the use of electronic forms of payment. So typically what happens is that there was a card holder and merchants, and these were managed principally by customers of the MasterCard Singapore, namely banks and financial services in that region. And services were provided under the master license agreement. Applicant also received various fees. Now let's look at the transaction process. The card holder makes a purchase with the merchant. Typically, we go to a shop and we flash the card, and when we flash the card, we make the purchase, and the merchant gives us the service as the case. But in the back end, the merchant forwards a transaction to its bank for authorization. This then is forwarded to the cardholder's bank who is issued the card. If the transaction is authorized, then the merchant is paid by the acquirer. Merchant would be required to pay a merchant service fee to the acquirer. MasterCard in the back end has facilitated multiple things. Authorization, the clearing, the settlement of the transaction with cardholder and merchant was issued. Then ultimately the entire settlement process through a settled bank, which is again appointed by MasterCard. And the processing centers of the group are in USA, Belgium, and Singapore. And the applicant owned the Singapore processing center. And what was the customer provided? The customer was provided with an interface processor placed at the customer locations in India. The applicant had a subsidiary in India, which 98% held by the applicant. Apart from that, various facts will speak that. What did the AR say? The AR said the automatic equipment can also create P. Imagine scenarios where you have this global ticket booking systems, where you have this Amadeus and things like that. You have hotel-related booking systems. So today, there's a lot of automatic equipment can handle data processing, collect data, to facilitate booking, facilitate authentication. So here the AR said automatic equipment can create P. Fixed place does not mean fixed to the ground. Interface processor at a customer locations throughout the year and pass the test of permanency. Ownership is not relevant. Even if it is higher, it is fine. Space at your disposal is enough to constitute place of business. The role played by the process was very significant, and its function was part of the transaction processing, which was the function of the applicant, and therefore they said it creates a P. Now, because of this ruling, if the applicant has a P in India and identified as a place of business, does it become an FE for the purpose of GST? So let's look at all the players here. You have, let us say, a vendor of goods where you flash that card, and he has got a small POS where you swipe that card. And then there is a local bank which has got an arrangement with MasterCard, and the bank is housing this particular processor, automatic processor. The data is collected, etc. So the bank is paid service charges. So the bank would have probably treated this as an export of services prior to a foreign company based on the default provisions. Now, if you're saying that the location of the automatic processor in Bank of India premises itself creates a permanent establishment, and that by itself will now create a fixed establishment, does it convert the transaction into a forward charge? What happens to all the others? So it's a mind-boggling question. There are no answers to that question which I'm going to attempt to give, but it's put apart to debate as to what can happen if contradictory positions are given. Because what happens is that companies will rearrange their matters to get out of these issues. They look at restructuring their business operations. So what would be the impact of GST and some other transaction-related decisions are taken for income tax? In the context of fixed establishment, there are interesting judgments in Europe. You have in European Court of Justice. You have the RAL Channel Island case, which is a very famous dish, where a UK company operated 127 amusement arcades in the UK. Machines were leased to a Channel Island company, and the European court held that the amusement arcades by itself were fixed established. Moving on to export and import of goods, we discussed service. It says that taking goods out of India to a place outside India. Import of goods is equally clear, saying that bringing goods to India from a place outside India. So somewhere there is a physical movement that something should jump from one country and go to another country and land in another country. In fact, not necessarily land, you should at least jump out of one country to another country to be export or import. That is why for customs purposes, consideration becomes irrelevant in the context of levy of customs duty. There could be a scenario where stock transfer is done. Goods move from foreign country to Indian country. Head office gives old computers. Let us say, for example, work from home scenarios. The manufacturing company suddenly discovers that all their people have to work from home. And being a manufacturing company, they never believed in laptops. They all had desktops at their office locations. And suddenly you have an entire accounting team of 150 people working from home. Their marketing team for preparing design is another 25 people working from home. Their support team and design team is another 100 people working from home. So they need 400 laptops at a sudden space, and laptops are not available because there's a huge demand. So let us say the holding company of this manufacturing company decides that we will give you laptop free of cost. So the head office decides to give, or the holding company decides to give this particular transaction. Let's say the head office gives to branch office as a stock transfer of 500 laptops. Head office gives to branch office. Now you will have to examine multiple issues. From a customer's perspective, import means bringing into India. So the laptops have come into India, therefore you must have a customs value. Now customs valuation can trigger customs duty. But for GST purposes, what would you do? For GST purposes, would you say that there is no supply for consideration, or you would tag on to the fact that the proviso creates a liability and the proviso takes me to the customs tariff effect, and therefore I will have to put an IGS charges? It's a big debate. So in the context of exports and import of goods, let's look at a typical business scenario of food development. Last week, there was also an AR ruling on this point. So Indian company receives tool development charges from a foreign associate company for manufacture of mold. So the foreign company says, I'll give you money. You develop the mold. And with that mold, what should you do? You must manufacture components. And that components, whatever you do, you should simply export back to me. So my contract with the foreign company was to develop the mold, create that effective mold, use the mold to manufacture components, and then export the components, for which I'll receive money in foreign. Now, I also receive payments for receipt in molds. And the foreign buyer says, I'll pay you for the mold, but keep it. Keep it till you complete in manufacturing. The Indian company identified the sale of mold as an export. Now the question is whether there is an export by the Indian company since monies are received in convertible foreign. Some interesting decisions. Karnataka High Court in IBEX case, this was way back in 2012, almost identical facts. What Karnataka High Court said that delivery could be actual or symbolic. And in this case, delivery is symbolic as soon as it becomes the property of the foreign company and was held on behalf of the foreign company. Therefore, they said the Indian company is acting under the instruction of the foreign buyer for further manufactured goods for the benefit of the foreign buyer. And therefore, the moment you receive the money and appropriate for that particular mold, sale had taken place. They said sale had taken place. Delivery should be perceived as symbolic. Delivery has also taken place, and therefore, this is a local sale liable to Karnataka VAT and not liable to export, but you cannot treat the transaction as export. Now, what happens if this decision is applied? If this decision is applied in the context of GST, are we going to say that delivery has happened in the state where the molds are located, and therefore it is a supply, and therefore it is liable to GST and CGST and SGST as the case may be? If it is an export, you'll fail miserably because the goods have never left the country. So it won't be an export of goods. The Madras High Court had an interesting view. The Madras High Court said, this kind of transaction cannot be said to be a sale, much less within the parameters of Section 3, as there is no movement of goods at all. So they looked at it differently and said, look, you have to create the mold, yes. You have done it for that other fellow, but have you moved the mold? The mold has not moved from a location. Therefore, there is no movement of goods at all. Since the goods have remained with the assessee, and because they are dies and tools, and it is from these dies that finished products are manufactured, since the die never moved to the factory premises, there is no question of tax liability. Completely a different perspective. Next. The Mumbai High Court gave another perspective, which I would sail along with, because it kind of factors the commercial element of the transaction. So what the Mumbai High Court said is, what is this consideration? consideration is typically for the purchase of goods. It will also include the price strictly for other amounts payable by the purchaser, which represents expenses incurred for completing the sale. And therefore, whatever money that the Indian entity receives for designing and tools are nothing but necessary concomitant to the final price of the product that is being manufactured. So the seller would not deliver the seating system without recovering the cost of the designing of the molds, which are again recovered only for the manufacturing system. And therefore, they said the development charges for designing and tool have inescapable bearing on the delivery of the system, and therefore they have to be held as part of the sale price of the seating system, which means the tool cost and the mold cost should be treated as part and parcel of the value of the component. And the component is in fact actually exported. And therefore, there is an export of goods for a consideration. This value can only be added to the export of goods value and should not be treated separately as a separate supply. We treat it as a part and parcel of the chain of supply that was required to manufacture the component, which was ultimately meant for export. Now I'll give a twist to it. The foreign company then says, okay, you manufacture the goods and give it to me. Plus, you manufacture the goods and then I'll instruct to whom to deliver. So they say there is a customer in Hyderabad, there's a customer in Chennai. Please go and deliver those customers from Mumbai also. So as a Mumbai entity, you have received money for the mold, you have made the mold, you have made 100 products, 80 you have exported, 10 you are supplying to Hyderabad, 10 you are supplying to Delhi. How do you deal with those two transactions? Now, Section 7.5A of the IGST says the supply of goods or services both where the supplier is located in India and the place of supply is outside India shall be treated as a supply of goods or services both in the course of interstate trade or commerce. So, should we then say that this is a transaction which is an IGST supply? This is an IGST supply made by the foreign company from the premises of the Mumbai party, and therefore the foreign party will now have to take GST registration as a non-resident taxable person carrying on business in India. Now, if that, in fact, many of them do this, but then you have to probably say that if this amounts to carrying on business, you may probably have to go to FEMA for permission first. You can't just like that carry on business in India unless you're going through your policy which allows certain mechanisms. Whether obtaining a registration for the purpose of sale would create a P. Now, FDA, of course, you'll have to meet. FEMA, of course, you have to meet. But assuming you take a registration, and why are you going to take a registration? You're going to take a registration saying that I'm selling in India. I'm carrying on business in India. Now, that is enough to create a P. So, create a registration for the purpose of GST, for the purpose of the sale of 20 components can trigger an impact in terms of a P. And then the larger question would be, if an automatic processor like MasterCard processor could be treated as an P, what happens if some tax authority starts a view that a tool or mold itself can be considered as a P? What kind of litigation can flow? So these are mind-boggling issues as far as tool development is concerned. But the harsh reality is that these things happen, and in most of the cases, none of these issues get examined, and people assume that the transaction is either CGST, SGST, and whatever, and the local company decides to charge the tax as applicable. So ideally, the best way would be to probably go for to create ownership for the Indian entity and allow the Indian entity to make a sale to the customer and probably give the profits as commission or something like that. That's probably a much better solution than getting into a legal wrangle like this. So whether obtaining a registration purpose of for GST purposes can create a PFD. And now on the reverse question. So let's look at fixed place P under the Income Tax Act through treaty and judicial jurisprudence. Fixed place of business through which the business of enterprise is wholly or partly carried on. This would meet your FE requirements also. Fixed place of business tests, location, geographical indication, and excess of business. Sometimes you have duration based, period specified through DTA. How many days you spend in India? How many days you spend on this project? How long is the construction project? Disposal. Whether the space is at the disposal of non-resident. You had the Formula 1 where they say that particular space was meant for you and given to you, and therefore it was creating a P at that point of time. Function, whether business is actually carried out from the place or that is not actually done. So that makes a huge difference as far as the status of PE is concerned. Next. This is the complication for the goods and services segment. Look at the digital economy perspective. Now, if you look at the digital economy perspective, everything has become digital. And today, internet is completely gone beyond emails. In fact, some of you are very seniors on the call, and some of you would be such young juniors and fresh professionals who will find what I'm saying as quite amusing. There was a point of time when if I had to send an email, I have to go to one cyber center or an internet center, and then go wait for the desktop to be made available. And there is an hourly charge, was quite costly. And then I open the desktop, and then I have to connect. The connecting process would take about 7 to 8 minutes. All kinds of static and sounds flowing through, and then I will finally connect after a certain percentage of work is done. That the connection is final. When the connection comes, and by the time I log on to a Yahoo ID, or those days it was Hotmail ID, and start working on your emails, the connection will go away. And from there, where are we today? We have the stride, the digital stride is phenomenal. Today, in families, there's always a big debate as to Wi-Fi. And many houses have their own Wi-Fi, and it's a constant debate as to what is the speed of my Wi-Fi. Then any amount of speed doesn't seem to be enough, because there is tremendous pressure on data, and the kind of cheap rates at which data is available is unbelievable. So, really speaking, we have opened our digital world in a very big way, and therefore e-commerce is a natural growth. And let's take films. Films, there were times when it had reels where the film had to come in a metal box. Until that metal box comes to the theater cannot function, the film cannot be screened. So from reels, we moved to discs, and from disc, we moved to the cube in theaters. And today, because theaters are closed, even have releases, live releases on Amazon Prime. And you have Netflix watch parties whereby people watch the film together and chat together. So everything is live, everything is streamed. Content has completely moved from that physical form to digital. Take music. What was the gramophone LP record? From there, it moved to this famous cassette. And many of us have used that cassette nostalgically. We would buy one a TDK D60 or D90 and carefully choose the number of songs to record it, because the money was very limited. You could buy only one empty cassette, and you have to have capture about 12 songs in a D60 cassette, and hear it, and then replace it with reluctance if another set of good songs come into play. And if something gets stuck, you remove the cassette out, use a pencil, and make it all right. So from there, we have moved to CDs, and from CDs, we moved to downloads, and now in live streaming. So the product is the same, the service is the same, but the deliverable has changed. So I would call it as same business and new solutions. So the desire is there, then there is a delivery, but now the journey is very different. So let's take a customer in Chennai. He places an order on the portal of a Cayman Island. And then the Cayman Island company gives instructions to a US company. And based on the instructions, the goods move from warehouse in US to India. And then your courier agency goes and clears and delivers the goods. This is the transaction. The journey is different. The journey is effectively the same. There's a digital dimension to it. Transaction involves goods, we are clear. There is an import into India, and there is a payment of custom duty and probably IGST. Vendor is located outside India. Revenue in respect of this transaction goes to a US company as well as Cayman Island companies. Is this transaction very different from a normal supply of goods? Same could have happened by I'm sending a purchase order by courier, and the purchase order is received by the foreign company, and the foreign company dispatches the goods by ship. The ship lands in a port, and then I go and file a bill. My agent goes and files a bill of entry and clears it. There's no difference. So this if they apply the same rules of business connection and permanent establishment that we have today, you would say that this business income generated is not taxable in India. But would the answers be different for digital products and services? Or the answers should be different for even goods and services because the digital platform was used? Take social media. All of us are woefully connected to this. And sometimes, it takes away quite an amount of time. In fact, today I was on a call with Mr. Datar when he was in his journey of 40 years into various people who were on the call. And he was talking about how we, without our knowledge, we waste time. And sometimes we think we waste in minutes, we waste in hours. Take a classic example of WhatsApp. You're in this conference. Now you're listening to me. You're supposed to have your undivided attention to the speaker. Then we're all humans. So there is a message that comes in WhatsApp. Now you would think that I will quickly glance and come back, but it is never possible. When you go for a quick glance, there ends the matter. You're so addicted to that message, and from that you get involved in the message and react to it. And then you see the next message, and then you see the next activity. And that's it. You've got 20 minutes, and suddenly you panic and then come back. But I'm not saying you're doing that right now because that will be not fair to an audience. I put just saying it could happen anywhere. It could be probably an environment where you're actually talking to your friend, but you're really not talking to your friend. You're talking to your somebody else. So what has happened is that they're all glued to the social media, Facebook, Twitter, Instagram, LinkedIn, big time. And they're extremely popular because age is not a barrier. You may be an 85-year-old person, but you will be actively posting in all these social media accounts and watching it every day. In fact, most of the biggest challenge today is the old people who read all these messages and panic. My mom is about 82 years old, and every day she has this question that all banks have collapsed. There's a financial collapse in the country. The pandemic has finished the country. Everything will no longer be available. So I always ask the first question: did you see WhatsApp? Tell yes. Then okay, I'm not going to answer. The fundamental rule: if your source of information is WhatsApp, don't waste your time. Let's not discuss this. I'll give you one answer. None of them are true. Everything is fine. This life will go on. So then she smiles and goes away. But it hits her every day with this kind of news because it's popular across ages. Because why is it popular? It is easy. It is extremely easy to get connected. The interest of the user is phenomenal, and the privacy concerns are all given a go by. Nobody bothers about privacy. That is of course, if you are a little more alert, you will be bothered about privacy. Okay, I want to ensure that I will not give all the access to all my when I give this app, when I download this app, I will not give you access to many other information. But then the question is, you won't be able to use that app. The app would be so designed that unless you say yes to multiple things, you will not use the app. And your incentive to, or your interest to use the app is much more than the concept of privacy. And of course, Indians have one more philosophy. The philosophy is very simple. What I'm chatting in WhatsApp, or what I'm chatting in any of the other Insta media or other accounts, or Instagram, or if some Chinese company or some other company wants to listen to it, let them listen and be damned. It is their problem to listen to the kind of discussion that we have, which is anyway irrelevant. So therefore, some people have this notion that what are you going to take from the privacy? But that cannot be true. There could be other content which you might have, which might be quite sensitive. We don't have effective lack of privacy laws. We don't have data privacy laws. They're not adequate. And the best thing is that we provide free data. We just give data. In fact, I'm also sure all of us are on a Zoom call. At some point of, or for example, it's not that another platform is superior. Let's look at Webex or anything that is free. There must be a catch. Why would somebody offer something so free? Where is this revenue coming from? Why is Facebook giving it so free? Why is Twitter asking you to tweet all the time? What is the freedom that is? What is the freeness in this whole event? Because we provide massive free data, and based on that, there is phenomenal analytics. Once you do the analytics, there is targeted analytics. So let us say somebody in Jaipur relocates to Chennai and comes to Chennai, and as soon as he comes to Chennai, he posts in all his social media accounts, I've come to Chennai, bye-bye Jaipur, a lot of sentiments in Jaipur, bye-bye, bye-bye, blah, blah, etc. He says, and he posts that he's become a VP of so-and-so company and has come to Chennai. Now, this is a data imprint. Now, this data imprint will be analyzed in the backend by systems, and AI would come into play. And based on this data, now you are very clear that someone has moved to Chennai. He would need a place. He would need furniture. He would need Swiggy. He would need food. He would need so many other things. And then suddenly this person who has come to Chennai will find that this Facebook is bombarded with various kinds of advertisements of these segments. And he's getting targeted SMS advertisements specifically of what he has discussed, because your phone, your data, your laptop, everything is connected. Your Google is connected. Therefore, you are virtually, there is no concept of privacy, so to say. But of course, all of people get really obsessed with the Setu app and say that the Setu app is violation of privacy. Every other account that you are using is full violation of privacy. But we have accepted, we have lived through it. And then the consequences are also that data is collected and the data is analyzed. So targeted advertising is born. Everything has become connected. Advertising has become a science. The key is, how free is it? If it is free, then there's a catch.
Excuse me, sir.
Yes, sir.
Sir, again, your voice is falling a little short.
Okay.
If you can speak a little louder, if I may request, it could be better because it is sounding weak.
Okay.
Thank you so much, sir.
Yeah. Company has got headquarters in Ireland. Customer data in India is analyzed. Then there are patterns that are emerging. Now, based on these patterns, the information is sold to advertising companies and the vendors of goods and services. So now the question is, can you say that the creation of market in India itself creates a taxable presence? And then can you say Can profits arising out of sale of data generated can be taxed in the market jurisdiction? This is a typical example. Your social media company is located in Ireland. The data is thrown in multiple formats from various devices. You have IoT at play, you have AI at play, and in the backend, every device is connected, and therefore so much of data is thrown. All this data is analyzed in the backend. Because basically, what all we get is raw data. This raw data is then put into data lakes, and then from the data lakes, the data is processed to have a meaningful analysis of the data. So, can you say that based on the information that is generated, something is sold to advertising companies, and can you say creation of market creates a tax? While digital economy seems to ring-fence certain transactions, economy across all sectors are moved towards digitization, and today business happens sans a physical presence. What is critical is there is no change in the customer, there is no change in the consumption, but the mode of deliverable has changed, the mode of execution of the same business has changed, has become, and COVID will make it even more digital. COVID will drive towards digitization because physical will be abhorred and shunned, and people look at how quickly I can change my procurements in digital format. So governments are seeing laws of tax revenues because they established rules require a physical presence, established requires a permanent establishment, established rule requires an office, and none of them exist for these companies. Next. This company was a florist, and what he did was he used advertising on search engines by Google and Yahoo to generate business. And payments were made in respect of the online advertising to Google Ireland and Yahoo USA. Now, the tax authorities in India took the view that you should have deducted tax at source because the income of the non-resident was taxable in India. The Calcutta bench of the ITH, in the case of Wright Florist, held that the traditional concept of PE, which was conceived at a point of time when internet and e-commerce was not even on the radar, does not really fit into modern day world in which virtual presence to internet in certain aspects is as effective as physical presence for carrying on the business. Next. A very interesting observation. While website per se, which is a combination of software and electronic data, does not constitute tangible property as it cannot have a location which constitutes a place of business, a web server on which the website is located and through which it is accessible is a piece of equipment having a physical location, and such location may constitute a fixed place of business. And therefore, they said a search engine which has its only presence through its website cannot be a PE unless the web servers are also located in the same jurisdiction. And on facts, in that particular case, web servers were not located in India, and hence there was no PE. Now, what happens if web servers are located in India? The same decision can be used to say that the PE has been created. If PE has been created, if you follow, because they're saying it's a place of business. So it becomes a big angle by itself. And what happens if local laws change and local laws mandate that your servers must also be in the same location? If that kind of thing happens, can there be such laws? That's a big matter of debate. But for example, localization of data can become a very important aspect in financial transactions. If that kind of things happen, then we may even have this decision playing differently. Say that web servers are located in India, and this creates a P. Next. Now, let me give you an interesting Supreme Court decision from the US. There's a very famous decision called South Dakota versus Wayfair. Now, of course, US is in the news for very other reasons completely. This was a very famous decision which brought a tax perspective to the landscape. Let me just give a background of how it operates in the US. US does not have VAT. US does not have a GST. Their revenues significantly come from direct taxes. They have what is called as a state tax called as a use tax or consumption tax. So typically, if A sells to B and B sells it further to C, A is not liable, B is not liable because B sells further to C so long as C is in business. But if C is a consumer, then that transaction becomes a taxable. It's called as use tax. So what happened was there were a lot of companies which were not located in South Dakota, that particular state. They were located in other states, but they had a website. And through the website, they had significant transactions in the state of Dakota. And they made significant sales in that state of Dakota. And therefore, the question that arose was, the state of Dakota was not happy with the revenues generated, and they felt there's a loss of revenue. So therefore, they legislated saying that if somebody outside my state has got more than USD 100,000 of goods and services into my state, or it has done 200 more transactions, then that can create a deemed presence and that can create tax liability. This provision was challenged, went up to court. Supreme Court said such a section is valid. In the earlier decision of the Supreme Court in court, they said physical presence is mandatory. So the Supreme Court of US distinguishes old judgments and said that it is no longer relevant. The quill has created market distortion. And then they said quill did not have before it the present realities of intrastate market, where the internet's prevalence and power have changed the dynamics of national economy. Therefore, they upheld a state tax provision which said that if another state company through their website is going to deal with more than 200 customers or 200 transactions in my state, or supply at least $100,000 worth of goods in my state, they have created a deemed physical presence, and based on the deemed physical presence, they may have to pay sales tax in my state. So just look at how even countries are looking at it differently in terms of this. We have our own OIDAR. OIDAR is a reflection of the same thought process. OIDAR is well defined, where they say services delivery is mediated by information technology over the internet and electronic network, and it is automated, involving minimum human intervention and impossible to ensure in the absence of information technology. Had they stopped there, we'd have had a big debate, but they said, and includes services, and includes electronic services. They've listed out all the categories. It's a big debate as to whether includes electronic services should also meet the test of being automated. There can be a debate in a separate discussion. For the moment, let us assume that provision of ebooks or a movie or a music or a software is taxable. Advertising on the internet is taxable. Cloud service is taxable. Digital storage is taxable. Online digital content is taxable. So if it is taxable, then what follows? So here they're trying to make a distinction based on how it is done. So there is a foreign company supplying digital content, or foreign company providing a cloud offering. They look at two conditions if it is satisfied. Is the recipient address in India taxable territory? Is the credit card used by that fellow issued in the taxable territory? Is the billing address in the taxable territory? Is the IP address used in the device in the taxable territory? Is the bank account in the taxable territory? Is the SIM card used in the taxable territory? If any of these two conditions are met, then person receiving the services shall be deemed to be located in the taxable territory. Therefore, the location of the recipient of services deemed to be in the taxable territory when the supply is a cloud offering or a digital content, because you used a credit card from HDFC or you used your internet protocol located in Bombay. Next. Now we all know, we are all familiar with the import of service. Supplier is located outside India. Recipient is located in India. Place of supply of services deemed to be in India. This can become an import of service. Next. So I just give two examples to make it clear. Cacophony International is a partnership firm based in Chennai. It buys music online from an Ireland company and converts them into karaoke and sells the same in India. That means it procures an OIDR service and uses it for its business or profession or trade. Then it is an import of service. The recipient pays GST. Mr. Buff in Bangalore purchases music through the internet from an Ireland company. Now this is not fitting into the business or profession or trade. He becomes a separate category, non-taxable online recipient as the terminology goes in the provisions. He is an individual. It's a B2C transaction. Now what the law says, the foreign company should obtain registration in India and pay GST under OIDR services. You'll be surprised to know that there are 300 businesses which have registered for the purpose of OIDR. Now, what are the challenges in taxing digital? Now, at least through GST, you have tried to make some attempt. Through OIDR, you have said that, okay, you are supplying all these digital content, you are supplying cloud offering, you are supplying a movie, you are supplying music, etc. You are supplying something which will fit into this category. You pay tax if it is a B2C transactions. If it is a B transaction, I get my indirect revenue from my importer. But how do you tax under income tax? How do you determine the profits of the foreign company in India? How do you create a P for this company in India? Because here what you're saying, you're only saying you're required to register for the purpose of payment of GST. You're not operating business in India. You're still recognized as operating outside India, but you register for the purpose of GST and pay GST. And that to one location, Bangalore has been identified. So in digital economy, the biggest challenge is markets can be accessed without a physical presence. None of the traditional rules are effective. Greater reliance is placed on intangible and mobile assets. There are increased avenues for profit shifting. So source or origin principle of taxation becomes irrelevant in a digital age. Next. So now what is happening? Every country wants taxing rights by saying that your company is making money because of my customers. My citizens contribute to your revenue. Therefore, my citizens have created revenue for you. I need a chunk of it. I need some tax. I need taxing rights. So all countries, now interestingly, many people think that this debate has emanated from India. You'll be surprised. This debate for taxing digital economy has come from many other countries, and India is also part of it. France is very keen. Every other country in Europe wants significant digital taxes. They feel that a lot of money is lost through this business model. So market jurisdictions want taxing rights. I'm tempted to quote a 1923 League of Nations document on double taxation. Beautiful phrase. Oranges upon the trees in California are not acquired wealth until they are picked. And not even at that stage until they are packed. And not even at that stage until they are transported to the place where demand exists. And until they are put where the customer can use them. These stages, up to the point where the wealth reaches fruition, may be shared in by different territorial authorities. So now the question is, the digital product goes from one location to another location, touching upon various jurisdictions, and then there is a customer jurisdiction. So every jurisdiction seems to want a right saying, I have some connection to this transaction. I want to tax this element. So what did India do? India made an amendment in 2018. They brought in a concept called as significant, they expanded the definition of business connection. And then in 2020, this Finance Act 2020, they've substituted the explanation with effect from 1/4/2022. This is almost like that South Dakota principle, whereby they say business connection and significant economic presence can be created if there's a transaction that's for goods and services by a non-resident with any person, including provision of data or software in India, if aggregate payments or transactions exceeds numbers as may be prescribed. Just like US $100,000 or 200 transactions, something could be prescribed. Systematic continuous sourcing of business activities with such number of users may be prescribed. So there is a prescription to a rule. When 1/4/22 comes, we'll also have those rules. And then there'll be a mechanism to find out how much of income is attributable to these transactions. While everybody will think that, okay, this is a wise thought process because the whole world is debating how to tax digital economy and there is no solution at sight and people are still debating, therefore 1/4/22 gives a comfortable time. Finance Act 2020 brought equalization levy 2.0 version. And this levy is mind-boggling. 165A has come into statute from 1/4/2020. And how did it come? It was not part of the finance bill. During the Rajya Sabha debate, this section was inserted. So when we saw the Finance Act in COVID times, all of us opened Finance Act digitally during COVID times. when we read through the sections, I said, I'll discover what is this new section? 165A. So what is this 165A? Equalization levy at 2% on the amount of consideration received or receivable by an e-commerce operator from e-commerce supplier or services made or provided or facilitated by it. Very, very wide definition. Consideration, received or receivable by whom? E-commerce operator. For what? From an e-commerce supply or services. Okay. Does he have to make it? No. He can make it, can provide it, or he can even facilitate it. So if it does either of these three to a resident in India, or even to a non-resident in certain circumstances, or to a person who buys such goods or services by using IP address in India, then equalization levy is triggered at 2% on the consideration. Next. So it's very important to understand who is an e-commerce operator. Very clear, non-resident, who owns, operates, or manages digital electronic facility or platform for online sale of goods or online provision of service or both. Till now, it is fine. I have no problem with this operator definition. But what is e-commerce supply? E-commerce supply of services means online sale of goods owned by the e-commerce operator online provision of services provided by the e-commerce operator, online sale of goods or provision of service are both facilitated by an e-commerce operator. Now, this is mind-boggling. One is online supply of goods, sale of goods. Another is online provision of services. Third is only a facilitation of such an online sale of goods and online provision of services. And the last is combination of all these. Very, very wide definition. Next. So those specified circumstances also defined. Let us say there is a e-commerce company in Germany, and that enters into an agreement with another non-resident in France. And the understanding between them is that they would sell an advertisement which targets a customer who's in India, or the customer who accesses the advertisement through an IP address located in India. That is enough for equalized levy to come between two non-resident transactions. And the nexus is supposed to be the advertisement which is targeting customer in India. Or sale of a data collected from a person who's resident in India or a person who uses the IP address in India. Very, very mind-boggling provisions. And now if equalization levy applies, what happens, whether you will also call it as a P, whether income will be applicable to that, etc., etc. So that answer is coming through section 1050, whereby saying the income arising from any e-commerce supply or services made or provided or facilitated on or after 1st April 2021 is exempt under section 1050. Now, mind you, chargeability and levy comes from 1420. Exemption is only from 1421. So that's very, we initially thought it was an error, but we realized it was not an error. It was intended that it is going to be exemption apply only from 1421. Next. But this equivalence levy will not hit everybody. When does it not hit? If the e-commerce company has a permanent establishment in India, that is very rare, because if he has a permanent establishment in India, this debate becomes irrelevant. The taxation of digital economy becomes irrelevant. You would normally identify profits attributed to India. If the turnover of such operator is less than 2 crores during the previous financial year, it's like a threshold. And of course, online advertisement where the levy already exists. Now, what is the point of challenge for this? Your tax is on a foreign company. Now, the foreign company, at each time when it does a transaction of supplying goods or services online, it has to find out whether the customer is a resident in India. And resident in India, we know what kind of complexities can have. Then if he's dealing with a non-resident, he has to see whether that advertisement is meant for an Indian customer. Then he has to see whether the person is purchasing using IP address located in India. If all this is tick boxes yes, or any of them is tick boxes yes, then you should discharge equalization levy at 2%. Fine. What happens if it does not? This is an Indian law. The foreign company may not even be aware of this Indian law, because he could be located in Estonia, supplying some services to India. And we may not be aware of the Indian legislation, nor would be aware of the intricacies of section 165A or the understanding of the Finance Act through a gazette notification. Therefore, he may even miss it. So if he misses it by mistake, or he chooses that I'm not bound by a jurisdiction, how would you enforce? How do you enforce this particular law? How will the tax officer recover this equalization levy? The levy is on a foreign party. Same question is valid for OIDR also. How would you implement an OIDR levy and collect GST from the other person? And there could always be fragmentation, because there could be multiple companies that can always be easily created. So let me give you a transaction where I will explain the complexities. I'm coming to the fag end of my session. There is a software supplied by an e-commerce operator. First, I'm downloading the software. Now, download of software, they will say it is a e-commerce supply. Unfortunately, they have not made a distinction between supply of goods or services using the e-commerce as a platform or a digital as a platform. These are goods or services being digital. I'm completely okay with the law which looks at digital goods and digital services. But I'm not okay with the law. It says that just because you've used a platform and the goods actually come by ship, you can still tax it because the digital framework was used. That fine distinction has to be appreciated and incorporated in the legislation. Unfortunately, it does not have it. So let us say I download a software. Now the e-commerce supply would cover supply of online content, online software, everything will get covered. Therefore, there's an equalization levy. Foreign company has to pay this 2%. The consideration. So assuming you know what is the consideration, 2% is supposed to pay. Now I download the software. Is it goods? customs law would tell me that it is not goods, I mean, it is not subject to custom duty because there is no mechanism to levy a custom duty on a download of software. If the software comes in a dabba or a tin or a drive or a CD or a package software, if it comes physically, there is a bill of entry, there is a customs station, and through the customs station, there can be a customs duty. But if it comes online, it comes into your portal, it comes through your portal to your system, you have a license key, you activate it, it comes into your laptop, so it can't be subject to customs duty. Therefore, there is no levy of customs duty. Atul Kaushik, table of assessed that. Now, if there is no levy of customs duty under Section 12, can there be an IGST? Because proviso to Section 5 says, if there is levy of custom duty under Section 12, then IGST levy can also apply. So is it possible for me to say that download of software is not liable to IGST because it is goods, but it is not custom duty charge? But what happens if it is treated as a service? Now, if it is treated as a service, then I have an impact of IGST on import of services. Then whatever I pay to the foreign company by way of license fee as software, somebody is going to tell me, sir, please read the explanation to Section 9. You are paying money for a software. This is nothing but income accruing arising in India. It is royalty. Therefore, Section 195 will apply. Therefore, TDS is applicable. You are supposed to direct TDS under Section 9 read with Section 195. And DTA will not help because domestic law will prevail. Of course, I have a different view on that. If DTA can still prevail, because if you look at the judgment of the API court in Sanofi Pasteur, if you make an amendment in domestic law and do not carry out the amendment in DTA, there are certain consequences. You don't have a non-obstante of DTA, then the non-obstante of DTA will still prevail. That is a different jurisprudence and different thinking process. You have to look at that judgment and understand what I'm trying to say. The point is that the person who's harmlessly downloading a software from a foreign company has to take the rates on equalization levy. The Indian buyer has to debate as to whether it is customs duty, or if it is not custom duty, you should debate whether it is import of goods and pay IGST, or if it is import of service and pay IGST again. If it is IGST and import of service, if it is a service, it is the nature of royalty or license fee. If it is a royalty or license fee, should I pay should I deduct TDS on this particular transaction? And as if that was not enough, it is OIDR services. Therefore, if it is OIDR services, and therefore, if you are a customer who has received this software for your personal use, then the foreign company is supposed to pay GST in India. If the foreign company is paying GST in India, then can there still be an equalization levy? Next. Can there be a levy of equalization levy on a transaction which is identified as a supply and subject to GST? If supply of goods from a foreign country is not subject to tax in India, can an e-commerce supply of the same good be subject to a different tax fee? That's the point I'm trying to make, that the goods are the same. Just because a platform was used electronically, can it convert that and make a levy of equalization levy? Can Parliament impose equalization levy over and above GST? OIDR services to certain recipients are subject to GST in the hands of the non-resident supplier. Import of services now lie in the hands of the recipient, he pays the GST. Can the same consideration be subject to EL again? Because the definitions are the same, the scope of supply is the same in both the categories. And the larger question is targeting an Indian customer for advertisement sufficient territorial nexus? Do you have justification for the levy by saying you've connected to the Indian customer? Can you say that there is a target which is created, a nexus that is created? So the last but one slide, where do we go from here? On the digital highway, what you're going to see is every country will start its own unilateral action. There will be a linchpin effect. India's equalization levy will be borrowed, copied, modified, emulated in different countries. You will soon have virtual malls. Malls cannot be closed forever. At the same time, the visual experience is very important. So what will happen is augmented reality will come. And when augmented reality would come big time in terms of consumer usage, you will probably go to a small center, you will be sanitized, you will be given gloves or something, then you will wear this particular augmented reality gadget, and you will be visualizing the entire showroom of sofas and furniture and things like that, the curtains and things like that. You can specify your room sizes, and the entire software will play out as if that's your room size. And you can see how the sofa is kept, how does it look. You can imagine how your room would be virtually, and then place an order there. And based on your order, something could be manufactured in Gujarat and then supplied to you. So you may not need stock points, you may not need dealers, you may not need showrooms, you may not need warehouses for storage. You can work in a brilliant fashion using virtual malls. This will all happen, trust me. Employees are not available. The, 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 uh, the plight of the migrant workers is well known. All of them are struggling and they're on their way to their hometown. And after reaching their hometown, they'll be first of all so tired and exhausted. They won't feel like coming back to the place where there is COVID still active. So there is a possibility that companies may discover that employees are not coming back, workers are not coming back. If workers are not coming back and factory still has to go on, manufacturing still has to happen because slowly economy is getting up from its feet and there is a demand, then there's no choice but automation. So robotics will happen. Big time automation would happen. And then we'll go to the next mode of virtual consulting. Already we are in Zoom mode. The webinar is a classic example. So already clients discussions happen through consulting, through Zoom calls and through WebEx calls. So in fact, many of my client appointments I handle through any of these platforms. Because client calls up and says, "Can we meet?" I said, "What is the purpose of the meeting?" "No, I want to explain certain things." "Let's go on a call. We can explain. I can see you, and the timing is perfect. I'm not going to miss your word, or even if it is missing, I can do a WhatsApp chat to catch up with you." So today we can seamlessly do consulting with clients. And the advantage is that 5 or 6 people from 7 locations can all join in the call, and the entire thing can be a huge conferencing discussion. Therefore, virtual consulting is already started. It will grow in a very big way. And virtual consulting may also happen from the foreign space. You will soon have foreign consultants doing virtual consulting without having an office in India. It can have its own professional issues. There could be virtual consulting which can happen. So imagine what happened to the Clifford Chance judgment. There was this famous Clifford Chance Bombay court decision in the context of whether a lawyer from abroad uh, participating in a hearing in India can create a taxable presence for income getting tax in India. Then the court applied the logic of how many days did the lawyer spend in India, the days that were actually spent in the course of arguments, effective days, not preparation, effective days in India, and based on that they came to certain conclusions. We may not do that anymore. Courts are also moving to virtual courts. So if virtual consulting and virtual hearing happens, then the existing laws will be woefully inadequate. Therefore, lawmakers will in a hurry make up something and try to, if you press the button, enter your tax. They could come up with something like that. So the business grows so fast that the law will find it difficult to catch up, and the solutions could not be very realistic, and that would have its own challenges. Somewhere there has to be a via media that the business growing will grow. At the same time, the taxman should not lose its legitimate revenue. It cannot go beyond what is normally required to be taxed. Then there'll be new nexus theories. In fact, there is a famous, there is a decision of the Bangalore Tribunal in the case of Google, where they use the word naval cod. They said that this Google AdWords, this famous scheme, where you have this target addressing, said that creates a permanent establishment that is royalty and all this. That judgment, of course, is pending an appeal. That Google decision is an interesting judgment to understand how a very different view can be taken in any of these topics. What will be the role of GST? And GST creates further issues for income tax purposes. What is the role of equalization? What will happen? How do you attribute profits? How much of profits can you attribute to Facebook because it targets an advertisement? See, for example, it has identified that somebody has moved from Jaipur to Chennai. It has identified that there is an opportunity for furniture. It has identified for opportunity for rental. And therefore, that data of the customer is being sold to a furniture company and a rental company. And the transaction is consummated because this fellow clicks it and then goes to the website and places an order. And a certain amount is generated and that amount is shared with that company. Can you say that the entire amount is attribution of profits or some element of profits are to be attributed? What kind of expense would you justify against this? Big, huge questions for discussion. The last but not the least is cryptocurrency. As people popularly call it Bitcoin. Bitcoin is just one term, commercial terminology. Cryptocurrency is an ocean by itself. And RBI was not in its wisdom when they said that we'll ban it. They said we will ban it completely. And then the Supreme Court struck down the ban. My view is you should regulate cryptocurrency. If you do not regulate cryptocurrency, the more and more you go digital. The whole idea of doing digital is that you want to avoid black. Governments are very clear that cash transactions should be avoided. People should go digital. Cryptocurrency is the equivalent of cash transactions on the dark web. Therefore, if you leave that space, you're lost. So I should feel that at some point of time, India should launch a digital currency. India should probably be the first one to launch a digital currency. You move up to wallets, you can go beyond wallets and have a digital currency that can have same respect as a normal currency. My last slide. This is a peculiar Japanese proverb which I'm quoting. Normally we say the oak tree is strong, but bamboo that bends is actually strong. Why I'm using this context is that, are you resisting change or are you embracing change? The world will change. Post-COVID, everything has changed. Everything will change much faster. So are we ready to grasp that change? Or are you going to say, no, this is temporary. Things will come back to normal. Things may come back to normal, but then it will be a new. So for the new normal, you must be ready. And that's why I said the bamboo that bends is going to be stronger than the oak that is. Thank you. My next slide is the last slide.
Extremely thank you, sir.
Thank you very much.
Yeah. In a minute or so, sir, we'll be taking the queries.
Yes, please.
Which are posted. But anyway, thank you for a very, very detailed discussion and the interplay. Now, I'm sure everybody is quite clear with the concept. Thank you so much. And I will request Nitin Bhai and Ranjan Bhai to take up the queries one by one. Nitin Bhai, can you take the first one, please?
Yeah,
sir, are we ready? Sir, are we ready? And you want to wait for a minute, or should we start?
Please go ahead. Please go ahead.
Nitin Bhai, please go ahead.
Okay, sir. The first query is ki, it is in response to the Zoom platform where we are having a webinar. The invoices are raised in the convertible foreign exchange. We are paying the money in convertible foreign exchange. And it mentions that you are connected to the Zoom global network via data center in India. So considering that Zoom has a fixed establishment in India, so can we say it is not an import of service and therefore GST RCM not attracted?
Well, I think I'm the culprit for starting this topic, and therefore the question has logically followed. I may not be able to answer fully because that something else is pending an opinion on this issue. But let me give you some perspectives. The perspective is this. Clearly, Zoom is a foreign entity. You cannot directly provide these kind of services. It's like this. You even for a house, you may have a sump in the bottom or a well, but for your water to come through your pipes in the bathroom, it has to go to an overhead tank, and from the overhead tanks it flows to the pipes. Or take a petrol bunk. The petrol is kept in the basement kind of a bunker, and from there it goes to the equipment, and from there it comes in limited weight of cars. Like that, when these kind of complex services are provided seamlessly, it cannot be possible without another entity in place or without another center itself. So there will be a network player that is required. There will be somebody who's in charge of moving the data. There will be multiple players involved. And just because there is a data center or a point through which it hits and comes to you, or is relayed to you, or effectively transmitted to you, that in the chain may not become a place of business for the foreign entity. That may not play the role as MasterCard automatic data processor. MasterCard automatic data processor, despite the fact that the judgment is challengeable and is pending in courts, only is challengeable. The interesting thing is the processor does. If you have it's a very big judgment, runs into hundreds of pages. You need a lot of patience to go through the judgment. If you manage to go through it, there is a technical write-up on what the processor does. That's very interesting. So those kind of things will have to be examined to see what is the technical role that is played by the data point in India for you to conclude that it is a place of business. Otherwise, you'll have to treat it as the person is a foreign party and you are an Indian customer. So then is it a B2C transaction or a B2B transaction? So have you taken this Zoom license in the name of your CA firm and using it for your firm purposes? Or are you taking it in your personal name for your individual usage? So if it is individual usage or B2C transaction, then the liability is clearly on the US company. They have to discharge OED. But if it is going to be an import of service that place of supply is in India, then it is the import of service. Of course, you will get GST credit.
At least in CGPI, we have taken it in the name of CGPI.
Sir, the only problem arises that when we do this subscription, it does not allow us to enter our GST number. It's a technical flaw.
You'll have other questions. Have you examined the royalty issue? I mean, the TDS issue.
Yes, I was about to come on the next is section 9, how it will impact, whether I do, should I go for form 15 CSCB or not?
So this is clearly Zoom's business income. So in that sense, they get money, business income out of it, and you can take a general position that it is not a PE. And you're not getting phenomenal rights. You're not. You're getting only a platform usage rights. You're not getting, even though they may call it a license. There will be a debate. I'm not posing the topic. There will be a debate just like software, whether it is what you pay is right to use a copyrighted article, or right to use the copyright, whether there's some kind of transfer of technology, all will come into debate. So traditionally, CAs have this comfortable rule, no? When in doubt, deduct.
Correct, sir. Over to Rajat.
But it is paid by credit card, sir. Right, sir. Next query. Before those queries that are in chat box, I had one particular query from my side, sir. In the cases of cryptocurrencies, when we read that judgment of this is Nariman of Supreme Court, in case of that RBI ban, it clearly says that it is not goods, but it is something which is currency and more. So is it a service for the purpose of GST? Can we take that point that it is a service? And if it is a service, then whether the GST would be leviable on the whole transaction? That is something which was very intriguing because there are a lot of transactions that are happening in this space. So what is your view on this?
I've discussed this elaborately in my book. There is a specific chapter which I've devoted to cryptocurrency. Probably get some insight of what thoughts there are. Also, I've touched how UK has looked at it, and whether cryptocurrency by itself is an asset, and if it is an asset, how do you treat for capital gains and all that. UK has done a brilliant job of this.
Right.
So the next query is in case of a place of supply in relation to services, as still it is confused with the place of performance. Is it the correct interpretation? If not, then please throw some light.
Can you repeat the question, please?
In case of a place of supply in relation to services, as still it is confused with the place of performance. Is it the correct interpretation?
Understood.
Yeah.
Understood. I'll give an example to make it clear for the gentleman. He is a chartered accountant providing consulting work. He gets a assignment from a US company, and the US company has given this mandate to himself. We see India as a growing opportunity post-COVID. So please analyze various state locations and state laws and tell me which is the best state for me to operate. Because I want phenomenal labor relief. I want ease of business. I want when I land, I should operate. So this chartered accountant travels, once he's allowed to travel, he travels to different parts of the country, goes at different locations, spends time in UP, spends time in Gujarat, spends time in Tamil Nadu. And then let us assume he recommends UP based on the labor law development, saying that UP is the best. Assuming he gives a report. Now, he might have done all this homework, etc., in India. But what is the crux of the service? The crux of the service is the advisory. Advisory has been provided to a foreign company. The foreign company is located outside India. How he performs the service is irrelevant. The nature of the service is advisory, and the nature of the service will take him automatically to the residual provision, which says location of the recipient. Location of the recipient. So you should never bring in performance as a test unless the section mandates you to do so. So if the section says that you must link it with performance, that the section requires you to handle goods, the section requires you to repair goods, then you have to look at where the goods are. Again, it depends on whether you are a primary contractor or a subcontractor. For a subcontractor, you may even take a position that may quasi-contract, subcontract to the main contract, goods are not even involved. It is a contract to contract. I will use residual. Whereas main contractor goods to be involved. There are multiple views possible even in that segment if subcontractors are involved. But if you are looking at any transaction, don't look at how you execute it or where you execute it or whether physical performance involved, unless that section mandates that performance is the place of something. Otherwise, you should not be bothered.
Right, sir.
Okay. Ranjan, next one.
Yes, sir. There is this query which is asking the clarification on section 2, subsection 6, the export of service definition. It is the last clause, which is fifth clause. It says that the supplier of service and the recipient of services are not merely establishments of a distinct person in accordance with the explanation 1 of section 8. So, what do they mean by this merely establishment of a fixed person? Are the branches or LOs are covered in this particular case, and there they won't treat it as a export of service? And what is the four corners of this particular phrase?
Two thoughts. The first one would be whether the word mere has got a significance. The word uses mere establishment. Mere seems to indicate a very, very minor perspective. We use very casually, merely like that. Sometimes English interpretation comes into tax. So we have to interpret what is mere. If we interpret what is mere establishment as a very thin facility which does not play a very big role in the entire chain of business, which does not actively participate or executes business in any format in the chain, then we can say that mere establishment will not cover an active branch. It cannot cover an active place location. Therefore, this explanation is not hitting. That again, of course, huge interpretation, huge disputes, etc. Therefore, the government in the wisdom decided to exempt it through notification. But exemption is not the solution. In fact, what is export itself is a debate. Can you say that a service going from a holding company to a subsidiary company is export? But a service going from a head office in India to a branch office in New York is not export. So you will have to look at what is called as origination and destination. If something originates from a particular country and lands in another country, because the format of the persons involved in the transaction, it should be perceived as an export. You can look at an interesting Supreme Court 5-member judgment in sales tax in a coal case, and that was also referred to in the Microsoft judgment in the context of service tax, where they talk about where something is emanating and where something is landing.
Right. Right.
Okay.
Yes,
So
definitely.
the next question is ki there is a company A which is located in Japan, which directs company B in Mumbai to train its staff, which is a subsidiary of company A, that company C, which is located in Bangalore on phone or digitally. So company A will pay the consideration to company B for such services. Will such services would be termed as an export of service?
You're again getting to the debate of how you would interpret that particular clause with reference to performance. Typically, there is an interface, there is a training, there is a physical presence. So either the presence of the recipient directly or indirectly is required for the provision of these services. And that is how that particular section is worded. So question would be whether you should treat the Japanese company as the recipient of service.
Yeah.
If you treat the Japanese company as the recipient of service, then you should read 13.2 as a residual provision and treat it as, I have provided the service to you. You may ask me to do service here, it doesn't matter. There is one decision in the case of Samsung, I think, in the context of tax, where the contract was entered into between a foreign company and Indian company. And the foreign company mandated the Indian company saying that I've got various customers in India. When they come to you, you must do the servicing of their goods. And whatever servicing that you do, I will pay you the money. So in this kind of arrangement, the tribunal said that this was at CDMI phones at the point of time. The tribunal ruled that the service is actually provided to the foreign company, even though in the course of execution, the customers of the foreign company are involved, and it would qualify as an export of service. So if that is the only decision available, we'll have to see how much of testing and litigation appetite you have in terms of decision.
Yes, sir. There are two questions on equalization levy. I don't know much about equalization levy. I'm just putting the questions that they are written.
Go ahead.
Sir, could you please explain as to how timing issue on chargeability and exemption is a challenge for levy of equalization levy? First, and second is equalization levy needs to be deducted by a resident Indian, whether the same needs to be grossed up. These two questions are there, sir.
Oh, good question. See, first of all, the equalization levy version 2 is different from version 1. Equalization levy that came in 2016, the first one, it was on online advertisements. The liability to pay was on the resident. Foreign fellow would merely supply the services, and the TDS obligation kind of thing was created. But equalization levy 2.0 is different. Chargeability is on the foreign party. Therefore, the e-commerce supply company is supposed to pay the equalization levy, and there is no question of TDS obligation or withholding obligation as far as the beneficiary or the recipient is concerned. Number one. Number two, the challenge which I talked about is that equalization levy has come from 1/4/2020. Now, what is the rationale behind equalization levy is that this fellow does not have a permanent establishment. Since he does not have a permanent establishment, we want to tax it. That's the logic of the levy. Now, suppose because of these operations is generating income from India, that income cannot be taxed again as income tax because it defeats the purpose. And therefore, section 1050 says there is an exemption available for such of those persons who are liable to pay the equalization. The income that is generated of this will be exempted. Now, that exemption has come from 1/4/21, but the taxability has come from 1/4. And that is why there is a 1-year challenge. It should have come in the same year, but it does not come in the same year. So the big difference of equalization levy 1 and 2 is that 1 was on somebody recipient, whereas 2 is on the supplier of services. And that is why I brought the challenge as to can you levy an equalization levy when GST is applicable on the same transaction, given the fact that 101st Constitutional Amendment says that even entry 97 is subject to GST. So the entire subject matter was already under GST. Whether EL is valid or not, there can be a constitutional question that will slowly. But the bigger question that is going to mind-boggle everybody is that, say, some foreign company supplies these services for $100. Equalization levy is at 2%, therefore $2. Now, if he treats it as an indirect tax and bills you, it is going to hit you. And if that fellow is also liable under OIDR services, OIDR services supply, therefore valuation, therefore section 15. Section 15 says transaction value and excludes only GST. All other taxes will form part of value if it is on the same transaction and collected from the customer. Therefore, equalization is levy is collected from the customer. Then we will have this whole debate again. Either 100 plus 2 into GST or 100 into GST separately, 100 into 2% separately. So the issues are mind-boggling, let me tell you.
You're right, sir. Nitin bhai.
Sir, there is one more question. There is a company A that is located in USA.
In
USA.
USA.
And there is a company B which is located in India. Company B is providing services to a company A of, say, celebrity management services. Invoices have been raised in the convertible foreign exchange. Consideration also has been received in the convertible foreign exchange. But the company which is located in USA have obtained TAN under the provisions of the Indian Income Tax Act, and they have deposited the TDS in India. Apart from that, they don't have any other activity in India. In such a scenario, services rendered by company B, will that be treated as an export of service?
Simple. I would not get very boggled by other developments that I've taken, especially in the context of TDS. I'll give you an example as to how TDS can be totally irrelevant. I'm providing legal services. I'm a lawyer. Legal services, as you know, attracts GST under reverse charge.
Yeah.
Therefore, I've raised a bill for, let us say, 1,00,000 rupees. And my client is a business manufacturer. He's registered. Therefore, he pays reverse charge mechanism. Now, the client, for some vague reason or wrong reading of the law, comes to a conclusion that TDS is not under 194J but under 194C and deducts 2%. And Form 26AS plus the new version of Form 26AS, whatever comes. Now, just because he has deducted TDS at 2%, am I becoming a works contract? My nature of service will not get altered by the understanding of my customer or the TDS compliance which my customer does. Or take the case of reimbursements. There are many companies which also deduct TDS on reimbursements to be safe. Reimbursement should be governed by the pure agency principle and not by whether client deducts TDS at source. Therefore, the tax compliance done by the foreign company should not really pollute the matter. Look at Rule 26 completely. And then in terms of Rule 26, have you met all the conditions? You are located in India. Your recipient of the service, please understand, recipient of the service is the person who pays you money, client. He is clearly outside India. And the place of supply is determined by the IGST provisions, and the place of supply being a default provision, that is also location of the recipient. You also receive the convertible form. Just because some income is perceived or attributed in India and he obtains a TAN number and deducts TDS, may not alter the position. But if there is some operations that are going to be carried out in India, and those operations are also critical for these services, and the foreign company obtains a registration in India for this purposes and also becomes a P voluntarily or otherwise, then the whole debate which we discussed can come into play, whether some element of service has been provided, or we'll have to perceive that whatever PE that is created is only a PE for the purpose of the US company. My contract is with the US company. That office or branch in India is also providing service to its parent. So it is their branch and their head office equation, and I am not dealing with the branch. My client is only the US, and therefore I will go with this. That is how we have to build.
Okay, sir. Thank you.
Yes, sir. There is this one query in relation to that is not there in the chat box. I had this query that there is no location of supplier of goods
Yes.
in the GST law.
Yes. Yes.
And location of supplier of service is there, and the same way the recipient location of recipient definition is also there. So is it there on some purpose that they don't need us to identify what is a place of business where the goods are kept and what are the fixed establishment things which can be applicable there? By taking a simple example, we can see that if a dealer in Maharashtra has put some goods in Gujarat in a warehouse for merely obtaining a warehousing service, can that be said a fixed establishment, or there he need to take a registration and then place a supply provisions to be looked at accordingly? Or is it always so that it is not his fixed establishment and the location of the supplier of goods is always to be traced back to the Maharashtra location? So why the first question is why they didn't put this, and the second question is should the analogy to be drawn from location of supplier of service only? That is
good question, but I'll try to imagine what was in the minds of the government or the lawmakers. They had a huge challenge. The challenge which they faced was they didn't merge goods and services. And they merged goods and services, most of the issues would have got resolved. They didn't merge goods and services, therefore they had to treat them both separately with It's a different kind of rules and regulations for goods and different kind of rules and services. For services, it was easy because they had the place of supply legacy. Plus, they had the European example. Therefore, they could borrow from Europe and place of supply, and they could implement for services to what we have as well in that. For goods, they had only the CST Act at play. And the CST Act also had a transit sale at play by one. Section 6.2b transactions of the GST Act. Therefore, they have to ensure that the transit sale is also captured, interstate supply is also captured, but interstate supply in the context of place of supply. Because the CST Act had a legacy of physical movement, whereas the IGST Act does not require a physical movement; it requires a location of place of supply outside one particular state. And therefore, they were caught in some kind of quandary of how to bring the CST provisions as well as merge it with the place of supply concept which they identified. So that is why you will see when you read 10.1 of the IGST Act, the conflict will be perceived. It is not so clean, except for a first clause and second clause. Even second clause language can be a matter of debate. So, but somehow they managed to structure that. So I would say that their intention is clearly not to identify a storage location or some other location straight away as a place of business, unless there is an active business. Now, for example, let us take the case of a goods landing in Mumbai port. I am an importer, I can locate, bring it in any port. So I have an IEC code and I import the goods in Mumbai and then organize the goods from to stay 1 week in a warehouse in Mumbai and then or the customs warehouse. And from there, I deliver it to my location in Ahmedabad. Can you say that that port has become a place of business? And therefore, I should register the customs port. So it becomes ludicrous if you say private warehouse is registrable, public warehouse is not registrable. Then there is no fairness in the treatment. So I think somewhere they did not have this in mind as in the context of services. Plus, goods were measurable, and therefore they had clear ideas for. I think it was intended not to provide location of supply. Is my guess. I hope somebody retires and gives me better ideas to why they did that.
Excuse me, sir. Excuse me, everyone. In the interest of time, I think we should take the last two queries.
Okay.
Is that okay, sir?
Yeah, go ahead.
So this is a continuous query from my side, sir. And then Nitin bhai will take the last one.
Ranjan, when we chat in our lunch in the next RRC, I'll give you new perspectives.
Right, sir. That's great, sir. Okay. So Nitin bhai can take the next query then.
In case of a contract with a foreign company for promoting its app in India, such a transaction, will it be qualified as an export of service?
No different from the earlier example of consultancy for location of business in India. Or only you have to walk the tightrope of not falling in the trap of being an intermediary and being in the ambit of a marketing support service. So it requires two skills. One, a good contract. The drafting of the contract should be excellent. Two, you must live the contract. You can draft any number of contract clauses, and if you say I'll get remuneration at 5 or 10% of the total profits, you're finished. You will have to ensure that your substance over form test is also met, and it's truly a marketing support arrangement or a business support arrangement, and not a mere commission agency. If you're able to meet these kind of tests, you'll be coming out of intermediary. If you're coming out of intermediary, it will be a residual service. Therefore, it can be an export of service. It's tightrope.
Okay. So Nitin bhai, I am taking the last query, right?
Yeah.
This is a query that my client, an LLP, is based in Karnataka and providing virtual training services. It is charging from learners and paying fixed percentage, say 60%, to the trainers considering as professional services. Trainers are using their own platforms. Now, my query is regarding POS. If the trainer is in India, if the trainer is outside India, what are the taxation scenarios in both of these two cases? And also, is there any applicability on LLP as an aggregator?
This is virtually a professional question, but I would just give you a hint as to where you should look at. Focus on, for international transactions, focus on 13 in the context of performance and non-performance. And in the context of the trainers located in India, just look at section 12. You will get your answers on your own.
That's great, sir. Sheel bhai?
Vaitheeswaran, sir, we cannot thank you enough for the deliberations and the depth which you have taken us with. Thank you so much for your time. I'll now request Nitin sir to raise a formal vote of thanks.
Thank you.
Thank you so much, sir.
Thank you.
Good afternoon to all the participants of this seminar. I am privileged as well as honored to propose this hearty vote of thanks to the speaker, sir, for the prolific session we had today, whereby we have truly grasped the amalgam of income tax, GST and digital world by understanding the concepts of permanent establishment under the present law as well as that will be formulated in future and how they would be determined considering the development of information, communication and technology, which will lay down the foundation for our future generations to come. Speaker sir, considering the impeccable turning point of your deliberation, all of us are carrying wealth of bounteous knowledge, which would help each one of us personally as well as professionally. On behalf of CGPI and I personally extend a very hearty vote of thanks for gracing and adding immense value to this meeting and looking forward to seeing you again. Thank you,
Thank
sir.
you so much. It was wonderful to interact with all members and share
Yeah.
my knowledge. Thank you, CGPI.
Thank you.
Thank you, sir. Thank you.
Thank you, sir. Sir,
Thank
have
you.
a nice day.